focus on on the primary market then. Juniper Hotels, the 118 crore, 1800 crore IPO has opened for subscription today. The hotel developer is the largest owner of Hyatt Group operated hotels in India. Varun Saraf, the CEO, as well as Mr. Tarun Jaitley, the CFO of the company, join us on the show. Hi, Tarun and Varun, and welcome to the show. Thanks so much for joining in. Well, you're raising some money from the equity markets, but all that money is going to be utilized and it's going to be coming back to the company. So tell us, what will it be used for? And I think one of the key objectives is to reduce debt. So what is the debt? And post the issue, what does the debt come down to? Please go ahead.
Absolutely. Thank you for having us. Yes, it's a very important day for us. Yesterday we closed the anchor book of 810 crore. And we're happy to onboard some of the marquee global investors and a very healthy mix of very large local funds as part of our anchor book. So we are very happy with the response. Now, to come to your question, yes, 1,800 crores is the raise that we're looking at, out of which it's all totally primary. There is no OFS. The promoters are not even selling one single share, and it's all growth capital. We are using 1,500 crores of that raise towards reduction in debt, and 300 crores would be used towards GCP, which is primarily going to be deployed in productive acquisition strategy that we've detailed out in our meetings. Last year we had 300 crores of EBITDA, and 266 crores was the interest cost. So with the reduction of 1,500 crores of debt at an average cost of borrowing of around 10.8%, it will lead to 170 crores of just pure interest saving, which will significantly augment our operating cash flows, and that would be deployed going forward in productive asset buildup. We would also turn significantly PAT positive immediately post-listing.
Got it. Okay, all right. Just one more point. You said that the 1,500 crores will be used for debt repayment. So in absolute terms, what was the debt and what does it come down to?
So gross debt is 2,200 crores pre-IPO, of which the bank debt is 1,900 crores. And once we pay down 1,500 crores, the debt on the book, bank debt on the book would come down to roughly around 400, 450 crores, which would actually take it below 1x my prospective EBITDA. So, going forward, even if we have to fund our expansion plans that we've laid out of adding 1,000 keys on top of the 1,900 that we currently own, we would never top out, beyond 2.2 times, gross debt to EBITDA going forward. So our capital structure will remain quite healthy, and we will throw up significant free cash going forward. I would like to also take one more minute to bring out another point. Over the past 3 years, the sector has been affected by the pandemic, right? And despite that, I think Juniper has been one of the few companies in Indian hospitality space which has maintained a positive EBITDA right in the middle of the pandemic. We never went EBITDA negative. And that trajectory is going to just expand and grow going forward. And we have a 43% EBITDA margin last year, and we are on track to improve our EBITDA margins further as we go out.
Right. Varun and Tarun, good morning. Thank you so much for joining us, and congratulations on the IPO. If I heard you correctly, you mentioned that you turned profitable immediately after listing. Was this higher interest cost the only reason why you were still making losses? Because despite having an occupancy rate of 74-75%, the bottom line was still in the red. And correct me if I'm wrong, is that timeline correct? You would turn profitable immediately after listing, and do you expect that to sustain going forward as well?
Yes, absolutely. So you bring out a good point. See, that's what I was saying. Over the past 3 years, if you look at the trend, and we're talking about period which was impacted due to the pandemic, my EBITDA, even in FY22 was 30%. That grew to 43% in FY23. My PAT, which was a loss of 188 crores in FY22, became only 1.5 crores PAT loss in FY23. Given the the tailwinds in the sector and the robustness of the business that we are seeing right now, even if we were to keep aside the pay down of debt, we would still turn PAT positive over the next year out. If we were talking about FY25, we would still turn PAT positive, keeping us out the debt pay down. In fact, the reduction in interest costs will only augment significantly that operating cash flow. As I said, the saving would be 170 crores, which would be incremental, addition to my PAT going forward.
Right. So turn profitable by next year. Varun, a question to you actually. Your first half, the operational performance in the first half of this year has been lower compared to last year. Do you see that improving in the second half as we go into as we wind down on the year? And your average room rate, part 2 of my question is that your average room rate has improved now with the industry tailwinds as well. Do you see that trend also improving as we move forward?
Absolutely. So seasonality in our industry is a given. So the first half of the year usually is a bit lower, so March to September. The second half is always stronger, and we do see that in the quarter ending in December, the numbers have improved drastically. With respect to the ARRs, I think if you see the growth from 2023 to what we have in 2024, at least that it's gone up from about 9,000 or to about 10,500. And if you see, we believe this trajectory will continue. We are actually post-COVID, there was sort of a consolidation and the rates went up. But we do believe, given the way the supply constraints are there in the market, over the next 3 to 5 years, we have a significant upside on the rates remaining. Having said that, our portfolio focuses mostly in Delhi and Bombay. And these two cities have actual demand growth that we're seeing. And given that, we do believe there is a significant headroom on the ARRs going forward. Furthermore, if you see the occupancies are already at 73, 74%. If you see our assets are large assets. In Bombay, we have 550 rooms and 116 service apartments. In Delhi, we have 401 rooms. For these large assets, when you reach an occupancy above 75, 78%, there is significant room to improve the ARRs as well. Just one more thing, if you actually look to the region around us, right? So if you look at the Middle East or Southeast Asia, the rates in the luxury segment hover about $300. In India, we're still at about $130 to $150. So even in the global context, we do believe there is significant room for improvement.
Great news for your investors, not so good news for customers like me. Well, thank you, gentlemen, for joining in and filling us in with a brief update on this issue, and wishing you all the best. On listing day, we re-invite you all to join on the show, and we'll try to get some more concrete numbers from there on. But wishing you all the best and look forward to that date in the future. Well, for the time being, though, we'll slip into a short break. You come back, we'll continue to focus on markets and stock-specific action. Don't go anywhere.